Hello, everyone. Welcome back to the succession planning series. Today we're doing episode 3, which is going to be Financials 101. We've brought in the star of the show, Drew Jacku from JMH and Company. Drew, this is Drew's idea, and he's done this for Community Futures and for our business owners in the community a number of times. So we're really grateful to have Drew spearhead this whole thing. I'm just the Vanna White. I just turn the letters for Drew or whoever our guest speakers are. The first 2 episodes are available on our YouTube channel. And that was, those 2 episodes were with Shauna Feth from the University of Alberta and their Alberta Business Family Institute. Those 2 workshops were great precursors to this one. There's a bit of a break in the logical progression, in the sense that now we're diving into the nuts and bolts with a chartered accountant. Just let me get my email back on the screen. Whereas previously we were kind of going through what a family business can look like and what the 3-circle model looks like of where people fit in, so we can identify their concerns and their interests as we transition our business to an outside purchaser, a family member, or a key employee. So yeah, we're excited to have Drew with us today. Same format, it's a webinar, so Drew's going to be talking to a slide deck and himself, which is a little bit strange for him. We'll give him some slack there. That's his first time doing this. All questions are welcome in the chat. I'll manage those, and Drew will just plug along to get through our lunch hour here, and then we'll address those at logical breaks when he is ready. So Drew's just down the street here from us at JMH. He primarily works with small and medium-sized owner-managed businesses, particularly on compliancy for tax filing and reporting obligations, as many accountants do. But he's got his own passion, which is helping you folks with your overall business strategy and decision making. And a big part of that, as we've identified from the Brood survey a couple of years back now, is the succession planning. And we're trying to keep successful businesses in the operating and in the community, instead of just letting them pass by. Drew started at JMH in 2005. He became a CA in 2009, and he's been a partner there since 2013. He's married. He's got 2 kids, aged 10 and 12. And he was the treasurer and on the board of directors for the Friends of Medalta for 6 years. And he volunteers coaching hockey and baseball here in Medicine Hat. So, and aside from all of that, he's got a solid haircut, which I really appreciate.
Like
All right. I buzzed mine just to fit in, and I see Ryan Castle's here. He's another guy with a solid haircut. So, Wes, get on the program. Okay, I'm gonna mute myself, turn off my camera. Drew, if anything goes sideways, just wave your arms and yell. If anybody has a question, go ahead and put it into the panel. You're unable to speak or show us your face or Zoom bomb us. So it's all equal. All right, here we go. Over to you, Drew.
All right. Well, thanks for the intro, Mike. So I planned on just giving myself a little brief introduction here right at the start. So as Mike mentioned, my name is Drew Jack. I'm a partner with JMH and Co-Chartered Accountants in Medicine Hat. I graduated from the University of Regina in 2005 with a Bachelor of Admin degree, and came out to Medicine Hat here in July 2005 to begin articling for the Chartered Accountant School of Business. Obtained my CA designation and wrote the exam in 2008. Was admitted into the Institute in January of 2009. So I've been practicing as an accountant for 16 years now, primarily, as Mike mentioned, working with owner-managed businesses, anywhere from local sole proprietorships to international corporate groups with multiple different businesses in up to 5 different countries around the world. So I have seen a lot of different financial reporting over the years. I'm also responsible for our firm's compliance with the financial reporting standards that are set by the governing body that governs chartered accountants. So I have plenty of experience in dealing with those financial statements. So in my role, I review financial statements on a daily basis with my clients. So although it's second nature to me and I do it all the time, it seems to be a foreign concept to business owners, especially at the start of running their business. Business owners usually get into their skill or their trade because they have an interest and they feel that they have an ability to succeed in that industry and turn that success into financial success. But financial statements, financial reporting, tax filing obligations isn't their number one focus. So that's where I come into play and help them out. So my goal is to let them run their business, achieve that financial success. But I also want to work with them and make sure that they do understand and interpret their financial statements properly, because it's a very important business decision-making tool. So this process, it doesn't happen overnight. And in the next hour, I don't expect to teach everyone everything they need to know about financial statements. What I'm hoping to give you today out of this presentation is give you a process to follow when you're reading and looking at financial statements, so that you have that baseline understanding what goes into financial statements, what the different statements are, and what the components are in each statement. This first step is really important to move on to next week's topic, which is business valuation. And next week's topic for business valuation is not only going to be around selling your business, but also for those new people that are looking to get into a business and how much you're going to pay for that. So as Michael mentioned, there is the chat feature that's available. So if you want to post questions in that chat feature, we'll be sure to take a break and get to any of those questions here. So the first thing that most people do when they look at financial statements is most people jump directly to the income statement. I mean, it's sexy. People want to see how much money that the business made, but really that's a big mistake when you're looking at financial statements for the first time. So if these financial statements are yours and your accountant is presenting these financial statements to you, you know what, fine, you can jump to the income statement. But if you're looking at another business's financial statements, we need to start somewhere else. Where you actually should start is a few pages back. Right at the start of those financial statements, there's going to be a report attached to those financial statements. Now, that report is going to help us determine how reliable the financial information in those statements is. So what we need to do is we need to gain an understanding of what the objective of these financial statements are. Why are these financial statements being prepared? So you'll see in my first slide here, financial statements are prepared to provide information for the investors and or creditors to make financial decisions, such as the ability to earn income, generate cash flow, repay debt, or provide a return on investment. So in this case, if the primary user of the financial statements is a third-party investor or the bank, the motivation of the preparer is going to be to paint a really rosy picture of what happened in the last year and where the business is at. They want to encourage people to further invest in their business, increase the value of their business, or they want to ensure that they're complying with the bank covenants related to any lending that they may have. So again, understanding the user and who these financial statements are being presented for is very, very important. Now, if the financial statements are being prepared for the shareholders or for management, there's some other motivations as well, primarily tax minimization. So most of the time when clients are sitting down in my office, if they're continuing to run their business year after year, and their plan is not to sell their business for some time, the number one goal is to minimize the taxes paid. Nobody likes paying tax. They want to keep the cash in their bank. So these financial statements won't present that rosy picture. You know, it might make their business look worse than the actual operations, just for the purposes of minimizing what they have to pay to the government. Next, if the motivation is to sell shares or to sell your business, then you know what? There's a motivation to increase your earnings at the end of the year. You'll want to show a greater net income on the bottom of your financial statements in order to increase that purchase price. And And then number 3 here is performance bonus targets. So if your financial statements are prepared and you have a CEO, CFO in place in your business, and part of their compensation agreement is around performance bonuses or meeting specific objectives, there's an opportunity to manipulate some of the financial information in order to get where they need to be. So again, before jumping to the income statement, we need to understand, why are we preparing these statements? How precise is this financial information? They're never going to be 100% accurate, but we need to understand how precise and how reliable this information actually is. So the first thing that I look at when I'm looking at financial statements is, like I said, the report to the financial statements. So there are 3 types of reports that are available to attach to financial statements for accountants. The first of which is what we call a compilation engagement or a notice to reader. So this compilation engagement report will say right at the start that we're compiling data that's being presented by the company, and we're putting it into financial statement format. So there is absolutely no assurance provided that these amounts are free from material misstatement. As a chartered professional accountant, chartered accountant, we can't associate ourselves with false and misleading information, but these statements do not have to comply with the standards that are put in place by the chartered professional accountants. So again, once you see that notice to reader report, you got to think right away, okay, these are going to be less reliable than if another report is going to be attached to these financial statements. So this notice to reader report is the most common that you'll see. It's the cheapest, it's the quickest, it's the easiest, it's the lowest standard that is acceptable for financial statements to go to the bank. You'll see this on probably 95% of financial statements out there. The next report that you'll find attached to financial statements is a review engagement report. So for a review engagement report, they have what's called negative assurance, which negative assurance means that nothing has come to our attention that causes us to believe that the financial statements are not, in all material respects, reported in accordance with the accounting standards. Very fancy way to say we haven't found anything saying that these statements are wrong. We're not giving you assurance saying that these statements are right. We know that these statements, how do I phrase this? We don't know anywhere that these statements are wrong. So again, the accountant compiles the data that's prepared by the company and management in here, but we perform some additional procedures on that financial information. So some of those additional procedures: inquiry, analytical analysis, discussion with the client. So we gather an understanding of the business, how it operated in the last year, and are these financial statements consistent with our understanding of the business. So this does introduce a concept of what's called materiality. So materiality is a misstatement or error in the financial statements that would change the decision of the user. So if cash is out $10, it's probably not going to change your decision on what the business is worth. If cash is out $10,000, well, again, that depends on how large the business is. If we're looking at $1 billion business, it's not going to make a difference. If we're looking at a $100,000 business, 10 grand is a big deal. So that's the concept of materiality, and that comes into play with the review engagement report. So typically these reports are required at the request of the bank once your borrowing reaches a certain level. The third type of report that could be attached to these financial statements is an audit engagement. So this is the first level of engagement where we're actually saying that we're providing some level of assurance here. So we will say that, based on our testing, nothing has come to our attention that leads us to believe these financial statements are incorrect. So we've obtained, and the wording is sufficient appropriate audit evidence to say that these are accurate financial statements. So more procedures are performed on these financial statements in order to attach an audit report. So I put some of the procedures in here, sampling. So we will start looking at specific transactions. We'll do testing. We'll gain an understanding of the internal controls of the business, test those controls to make sure that they are functioning properly to catch any errors in the financial statements, that sort of thing. So looking back, if you don't look at this report, you don't know how much time and energy and effort has been put in to making sure that these financial statements are accurate. So notice to reader, very little comfort with. Review, a little bit more. Audit is your highest level of comfort. So I guess that's step one in determining how reliable and how much reliance we want to put on these financial statements. Now, another little trick that I use, and I suppose I've been at this for 16 years, so I've seen a lot of different philosophies on business owners here, but one thing I do look at is every one of these reports, whether it's an NTR review or an audit, is going to be dated. If you're familiar with what the filing deadlines and reporting deadlines are for financial statements, your tax payment deadline is 3 months after your year end, and your filing deadline is 6 months after your year end. So if you look at this report and it's dated within a month or two a year end, that usually tells me that this individual or this business has their financial statements and their records in good, clean, well-organized format. Typically, that would lead into other areas of their business as well. So probably more accurate, more reliable receivable information, inventory information, their asset listing, that sort of thing. It kind of it gives you an indication of their personality type and how they manage their business. So again, within a month or two, usually means they're on the ball, and you can probably translate that into other areas. If they're dated nearly 6 months after the year end, well, that tells me something too. That tells me that these financial statements are probably just prepared right before the tax deadline. So if it's prepared before the tax deadline, there might be a time crunch in the end where, you know what, you might not have full, complete information, but you got to get this return filed. Otherwise, there's going to be interest and penalties and everything tacked on by the CRA. So again, that'll give you a reflection on the personality type of the owner as well. And if it's after the deadline, I mean, they either have losses built up or they're the type of person that, you know, they don't really care. And does that mean that they don't really care about the receivables or to make sure that their inventory listings are accurate or their asset listing is accurate? So again, not 100% bulletproof. This isn't a standard, but this is just what I've found over the last 16 years is you can get information based on the type of report and the date that's on that report as well. The other thing that report will tell you is what the financial reporting standards being used are. So those standards are set by the Accounting Standards Board of the Chartered Professional Accountants of Canada. They're referred to as GAAP. So there's currently 5 different options that are available. 99.9% of the financial statements that you're going to see are going to be presented in accordance with accounting standards for private enterprises, which are the accounting standards that are used by, you know, your small to medium-sized owner-manager private companies. But there are other standards that are available. Not-for-profit organizations that'll give you an indication of the ownership type of the business. International financial reporting standards will give you an indication of how large the business is. You know, if they have multiple locations, that sort of thing. So, I mean, we haven't even actually made it into the financial statements yet. And we've been able to gather what I would consider some pretty good information on how reliable and accurate these statements are. So in these financial statements, there are some financial reporting principles and standards that I want to bring to your attention. So there's what we call the matching principle, which means if you're going to bring the revenue into a period, if there's expenses related to that revenue, they should be reported in the same period as well. Without that, you could have a mismatch. You could have inflated profits or inflated losses year over year. There would be a lack of consistency. So the reporting standards require that we report the offsetting revenue and expenses in the year. The next one is conservatism. So These financial statements should be presented in a worst case scenario basis, which means we delay the recognition of revenue until such time that it's known, that you know the amount of revenue, title is being passed to the customer, the service is being provided, whatever it is, and that you're sure that you're going to be collecting that revenue. On the other hand, on the expense side, if they have incurred an expense, we'll want to push that expense into the year. Even if it's on the fence, we'll want to potentially inflate expenses. We don't want to paint a rosier picture than it is, especially if people are relying on these financial statements. The next concept is historical cost versus fair market value. Financial statements are typically presented on a historical cost basis. So for example, if a company has rental properties and it's presenting under accounting standards for private enterprises, that rental property could have been acquired 25 years ago for $100,000. Its current value might be $1 million, but it's carried on the financial statements at its original cost. Plus, in addition to that, it's also amortized down. So you need to recognize that these are old costs. They aren't to reflect the current fair market value. So again, reading financial statements, just be aware of that. There is the concept of cost versus benefit as well. Financial statements are never going to be 100% accurate. The time and effort put in to get a 100% accurate financial statement isn't worth the cost in doing so. So there's going to be some concessions made when it comes to your annual financial statements and the reliability of the information. I explained earlier the concept of materiality, and then also that financial statements are presented on a going concern basis. So when we present financial statements, we assume that the company is going to continue to operate. If it is not going to continue to operate, then the valuation method on the balance sheet is going to look much different. So again, we've spent 25 minutes of our chat here, and we haven't even got into the financial statements yet. There's a lot of information to be gathered before you get into the actual statements themselves. As far as the components to financial statements, the balance sheet or the statement of financial position, which is a snapshot in time. That's a point in time statement, again, historical cost of the assets, liabilities, and equity, which we'll go through the components coming up here. Income statement or statement of operations. Again, this is well, actually, this one's based on a period of time, and it gives a report on the company's performance over that period of time. Statement of retained earnings, which is an accumulation of earnings since the company's inception that's being reinvested back into the business. Statement of cash flows, which is movements of cash over that same period in the income statement. And then the notes to the financial statement. So the notes provide additional information to all four of the above items. So number one, what is a balance sheet? So a balance sheet is that point in time statement. It contains assets, liabilities, and equity. An asset is embodying the future benefit to the business. So they have control of access to that benefit, and the transaction that resulted in them gaining the access has already occurred. This is just a complex way of saying the company controls it and they get to use it. They've earned it. So if you look at cash, it's in their bank, they can spend it. How did they get the cash? From past service. Same with receivables, inventories, that sort of thing. The balance sheet assets are reported in order of liquidity. So I'll pull up a balance sheet here. And you'll see on this balance sheet, it starts with cash, and then it moves into term deposits, and then accounts receivable, inventories. So this is going in order of your ability to turn your assets into cash. Cash is one of the most important assets when we're looking at the balance sheet. So that's why that is done there. There are certain assets that can be affected by management bias or accounting policy choices as well. So it's important to be aware what assets there are on the balance sheet and whether the value that is reflected is in fact their true value. So we talked earlier about, there could be some biases. we want to minimize our tax liability. So if you look at something like accounts receivable, well, if I want to minimize my tax liability, I might record an allowance for doubtful accounts on some accounts that, you know, I may or may not end up receiving. However, if I want to report, you know, the rosy picture to the bank and I want everything to look good, I may not write off an account that I know I'm never going to collect. So there's ability for manipulation there. Same with on inventories. There's an opportunity on inventories, either in the value of inventories, whether they're still good inventories or not. There's an ability to manipulate value. Investments, there's different accounting policy choices that can be made. Investments can be accounted for at cost, at fair market value. Capital assets is one, again, historical cost, but then you also determine how quickly you write off your capital assets based on your amortization policy. So those could be significantly different between two exact same businesses. Intangible assets, it's a decision on when you start to capitalize intangible assets. So if you're in research and development, at what phase is your product or service becoming financially viable? At that point, you have the option to start capitalizing those costs and recording an asset. You also have the choice to continue to expense those. So, and then future income taxes. So when you're looking at assets, there's some manipulation that can be involved in balance sheets. Going all over the place here. Liabilities. So liabilities are the exact opposite of an asset here. So you, instead of on your assets, you have a future benefit. Well, now you have a duty or responsibility. So you have to provide something. Whether that's something you have to provide is cash or service, that's the transfer or use of assets. And you have no discretion to avoid it. So you're legally obligated to pay. Again, just like assets, they're reported in the order of expected settlement. There's typically little discretion when it comes to liabilities. There's not a lot of bias that can go into it other than these two areas that I've identified here. So contingent liabilities. So contingent liabilities is something that's dependent on future events. So a good example of this is a warranty. If you provide warranty services on your product, there should be some sort of liability set up related to that warranty. If historically 1% of sales is what you've had to spend on warranty costs, then some sort of accrual should be set up. And then commitments as well. So if you've committed to donating 10% of profits to charity, well, if you haven't accrued that, you have a promise, you have a legal obligation. So something like that should be set up. And then the last portion of your balance sheet is your equity. So that's your ownership interest, very simple, assets minus your liability. In that equity section is your share capital. In the share capital, it starts to introduce the concept of common and preferred shares, which one is common are participating in future profits, preferred to have fixed value, and then voting and non-voting, which is self-explanatory. Contributed surplus, which is what you've contributed to the organization. So if you transferred assets in and you haven't taken what the value is back out yet, that would be your contributed surplus. And then retained earnings is the profits that you've accumulated over the years. So those are the components of a balance sheet. The analogy that I use with my clients is the homeowner analogy. So in that analogy, your assets, that's your house. Your liabilities, that's your mortgage. Your equity, that's how much you own in it. So what are some of the things that you should look at when you're looking at a balance sheet? So went through all the boring details. How do you look at a balance sheet and interpret that and read it and gather intelligence on this business? The number one thing that I look at is the current ratio. I want to see current assets to current liabilities. So dependent on the industry that this company is operating in, this can vary, but typically you want to see your current assets in excess of your current liabilities. That's showing that you're able to meet your debt obligations. Your quick ratio, very similar to your current ratio, except we're excluding inventory from this one. We want to know if you need to come up with the cash to pay out your suppliers, to pay out the bank, that sort of thing. Can you do so? Working capital, we're looking at the exact same figures here, current assets minus current liabilities. If you pay out all of your debts, what are you going to have left? And then debt to equity. How is your business financed? Has it been financed by profits over the years, or are you constantly borrowing? And if you're borrowing, who are you borrowing from? So those are some of the key balance sheet ratios that I look at. So the goal to all of this is I'm going to explain what goes into the financial statements. And then at the end, I'm going to show you my process to review financial statements to interpret what we've read through here. Income statement. So what is on your income statement? Starting at the top is going to be your revenue or your sales. That's the inflow of your assets. That's what your business does. It's selling goods or providing services and collecting whatever you're owed for those goods or services. Now, revenue is recognized when you transfer the risk or reward of ownership to your customer, and there's reasonable assurance that you're going to be able to collect that. So back to that concept of conservatism, we don't want to recognize revenue too early because if we're not entitled to it, that could be misleading the users to the financial statements. So there's an example on here on I have completed contract and percentage of completion methods. So this is for the construction industry. So if you're doing a long-term project, you can either recognize all of the revenue at the end, or you can recognize a percentage as you go. Next up on your income statement would be your direct costs or cost of goods sold. It's the outflow of the assets. It's using your assets in your business. This would be utilizing your inventory, direct labor related to a project, that sort of thing. So as I mentioned before, when we're reporting, we use the matching principle. So if there's revenue related to a project and there's a direct cost associated with it, they should be recognized in the same financial statement period. These are typically variable with your sales or with your revenue. They're either directly related to production or they can be allocated to specific jobs. The next item would be your expenses, which again, outflow of assets in your ordinary course of business. Typically, these are going to be your fixed expenses, those that don't vary based on the amount of revenue that you have in a year. So your rent, although some may argue that rent is a step cost, but whether you do 10,000 in sales or 20,000 in sales, if you're renting the same place, it's going to be a fixed cost. Same with your property taxes. So these are normally the costs that you have to cover by your margins in order to make profit, which we'll go over that ratio right away here. And then the next item on your income statement is going to be your gains or losses. So these are not from your ordinary course of business, interest, dividends, sales of assets or investments, that sort of thing. And then at the bottom is your income taxes. So again, we understand what an income statement is, what the information is that's on there. Now, how do we use that? So I use ratios to interpret the information. So the first one that I look at is your gross profit margin, which that's your sales minus your cost of sales divided by your total sales. So that shows you how much you made on every sale. So, are you making, and this will come out as a percentage. So are you making 50% on every sale? What's the industry standard for your industry that you're operating in? Your net profit margin, your net income divided by your sales. That one, I mean, if you're positive on the bottom line, it's good, obviously, but expenses as a percentage of revenue is one that I look at very closely. And I look at this year over year. So how much of your revenue are you spending on repairs? How much of your revenue are you spending on interest? Um, Again, that'll identify some key trends in your business. Break-even analysis is another important one. So you take your fixed costs divided by your gross profit margin, and that should tell you where your break-even point is. So this can be done on a per unit basis. And then the one at the very bottom, we'll talk in depth about this when we start to get into business valuation, is they call it EBITDA, earnings before interest, taxes, depreciation, and amortization. So once we've gone through the balance sheet and we've gone through the income statement, there are some combined ratios that we can use as well that combine the balance sheet information and the income statement. So the accounts receivable turnover, how many times per year are you collecting your receivables? Same as your inventory, how many times per year are you turning over your inventory? So both of those will tell you if you have too much cash tied up in your receivables or too much cash tied up in your inventory. Are you overstocked, understocked, that sort of thing. Return on assets and return on equity, good for investors to look at. How much do I have to invest in order to get the desired return? Statement of retained earnings. So like I said, that's a build up of your net income minus your dividends. And then there's the concept of refundable taxes, which is beyond our scope here. Next item in your financial statements is your statement of cash flows. So your statement of cash flow will show your sources of cash or your uses of cash over the reporting period on your income statement. So I use the indirect method. There's two different methods of doing your cash flow. The indirect method starts with your net income. So I find it's the easiest to explain. Your net income should be how much cash you receive, but there's some non-cash items in there. So amortization for one, we're writing down our capital assets. That's non-cash. Our gain or loss on disposal. The proceeds are cash, but the gain or loss is calculated based on a different figure. So again, that'll be a non-cash item. And future income taxes, there's other non-cash items. And then we adjust for changes in what's called working capital. So we looked at working capital was your current assets minus your current liabilities. So did your receivables grow throughout the year? If that's the case, then obviously you didn't collect the cash. So that's what comes down to your net income plus or minus your operating activities. That's how much cash you've collected or paid out from operating this year. The next section is your investing activities. So this is how much you invested back into your business, which is investing in assets or other investments, any receivables that your business gave out or paid off. And the last item on your cash flow statement is your financing activities. So this will have any debt transactions, any new borrowings, any debt repayments, and then your equity transactions, so shares issued, redeemed, dividends paid. Last but not least, your notes to the financial statement. So don't overlook the notes to the financial statements. They're most commonly overlooked. Like I said, people want to focus on the income statement. How much did this business make? There's important information in the notes to the financial statements. The nature of operations note, which will tell you what the company does, where it operates, that sort of thing. Significant accounting policies, which will tell you how they account for some of their assets, liabilities. It'll give you an idea of how reliable the financial statement reporting is, any judgments or estimates that management makes, and then it'll give you details related to specific items, which I have listed there. Interest rates on the debt, historical cost on the assets, transactions with related parties, debt repayment terms, and then commitments and contingencies, which we talked about before. So those are the components of financial statements. If somebody puts a set of financial statements in front of you, you should see all of those items presented in those financial statements. So the key takeaway from what I wanted to go through here today is let's come up with a process to read these financial statements. And this is my step-by-step process. It doesn't have to be everybody's step-by-step process, but it's the one that I find is the most reliable and to me provides the most information. So understand the purpose and intended users of the financial statements. So what type of report is being presented? Is this a notice to reader, review, or audit? And again, look at the date of the report. If the report is beyond the tax filing deadline, something's going on, maybe you ask some questions. If it's immediately after year end, you can probably trust the information. Step 2, I jump straight to the notes. So I go past all of the financial statements, and I'm only going to look at specific notes here. So what I look at is I look at the basis of operations and the significant accounting policies note. So I want to understand what the business does, where it operates, and what the ownership structure of this business is. So that information should be available in the share capital note. So now that I understand who these financial statements are intended for and what the business does, then at that point I go to the balance sheet. Looking at the balance sheet, the first thing that I do is I look at that current ratio. So I showed you the calculation of the current ratio before. Does the business have sufficient liquid assets to continue to operate? And then same thing with your working capital calculation. Next, I look at the accounting policy selected for each type of asset. So go back to those notes to the financial statements and look, what are their policies for accounting for inventory? Is inventory valued based on the average cost? Is it valued based on specific inventory items purchased? How do they account for their investments? Is it cost? Is it equity? There's different approaches that can result in different results on your balance sheet. Next thing I look at is your net equity on your balance sheet. So has this business owner been able to operate profitably and leave it in the business without utilizing it? So some valuable information that this might provide to you is, let's say the business was profitable, but the owner wasn't drawing the salary out of there. They still need the money to live, to pay their personal expenses, their mortgage, that sort of thing. So they've been taking it out as dividends. Well, they could have an extremely profitable income statement showing $100,000, $200,000 a year. But if they're stripping all the cash out of the business, it might have a negative equity position in there. So that net equity position will tell you something about potential owner draws and that sort of thing. And then next is the debt to equity ratio. So again, this will give you an idea of the business's financial strength. How is this business funded? Is it borrowing from the bank? Is it borrowing from the shareholder who is financially supporting this business? Or is it supporting itself through its past earnings? Step 4 is I look at the income statement. Now, I'm guilty like everybody else. First thing I look at when I look at the income statement, I want to look at the net income loss. I want to see how much money did this business make or lose during the year. But then I want to get some more information on that. I want to see, was there revenue growth? So I look at revenue from the previous year to the current year. Is it increasing, decreasing? What's going on? I also look at the gross profit margin and I compare that amongst the years. If you see gross profit margins going down, it might indicate that their product is becoming obsolete or the costs are going up and they're unable to pass that on to their end customers. It'll provide a lot of valuable information for you. And then expenses as a percentage of revenue. So I do spend a lot of time on the operating expenses. It seems to me that area is where you can identify some spending that is not under proper control, areas for improvement in the business, and it'll help you with operating the business going forward. So I do current year and prior year on a line-by-line basis for your expenses. And then my next step is I go to the notes. So in the notes, there is some important information related to related party transactions. So if the business is showing large profit, it doesn't own land or building, but you don't see any rent on there. What's going on there? Well, maybe there's another company here that's related to that business, and they're utilizing that space for free. Maybe they're paying large management fees out to related companies for the purposes of tax planning, and there's no profit on the bottom line because of that. So in that related party transaction note, there again will be some valuable information that'll help you interpret whether these financial statements are reliable and if they contain the right information for you to make your decision. So as far as using your financial statements, now that we've gone through a process, we understand what's in the financial statements, what items make them up, and how to properly read and review those financial statements. How do we use this financial information to our benefit? So you can use it to optimize the performance of your business. So your accounts receivable collection, for one. If you look at your AR turnover and you're turning your AR over twice a year, now you're financing your customers for 6 months. If you're in debt and you're paying interest on a loan, and in the meantime you're holding on to a whole bunch of receivables, it's costing you money. So maybe there's a benefit in hiring someone to ensure that collection is done efficiently. Same with inventory management. I've seen a lot of people get into trouble where I want to stock more inventory. I want to bring more product in. Well, if you're holding on to a year and a half's worth of inventory in your warehouse and you're short on cash, so now you have bank debt, maybe you're paying interest on something that you aren't using for a year and a half. Maybe there's a better inventory management system or process that you can use to save your business money. Resource allocation to product lines. So this was one that I noticed very early on. If you're providing multiple products, if you want to make the right decision, if you have limited capacity, you need to know the profits for each product line. So once you read your financial statements and you go, okay, my margins are, for product A, my margins are this, for product B, my margins are that, I have better margins on A. If you have limited resources, allocate them to product A. Help your business make more money in the end. Asset management. So on this one, if you look at the expenses as a percentage of revenue, and your repairs and maintenance is constantly climbing every year, you're spending 10% one year, 12, 14% the next, 16, 18 the next, maybe it's time to replace your assets. Maybe you're repairing your assets excessively and it'll cost you less just to replace that asset and either bank finance it or utilize your cash. So it'll help you make some of your asset purchase decisions, asset management decisions. Using your financial statements for financial planning. So budgeting. I'm a strong believer in you want to set goals for the following year. So you'll want to come up with your budget for 2022 based on your 2021 financial information. So have a look, set your goals, and those goals will also start to drive some of your business decisions. Personal income decisions is another one. So when you're reviewing your annual financial statements, maybe there's some freedom to increase your personal income for the year. If your business is doing well and you're doing some long-term planning, maybe you want to ensure you're still staying compliant with the Qualified Small Business Corporation share rules, that sort of thing. Without having accurate financial knowledge and financial information, you'll never be able to make accurate decisions on what your personal income level should be. Again, investing decisions, if you have excess cash, or even if you're taking investors into your business, you need to know what your business is worth, and you need to be able to read and interpret your financial information. Also very important to understand your cost of debt versus your cost of equity. So if you are borrowing from a bank and you have angel investors or outside investors in your business, which one is costing you more? are you able to access bank financing at a lower rate than what your investors are requiring you to pay back on an annual basis through dividends? So something like that will help you make better decisions and grow your wealth. And then financial planning, business valuation. So that's what we're going to get into next week is how much is my business worth? So when you're making decisions about, when can I retire? Can I afford to retire? You need to be able to read and understand your financial statements to make the appropriate decision. And then last but not least, I couldn't get away without throwing this one in here, tax and estate planning. So having accurate financial information will help you plan out your taxes. And I'm not talking taxes for the year. When I do tax and estate planning, we're doing lifetime tax and estate planning. So, is there a way to, maybe we pay a little more tax this year, but over a lifetime, there's a savings. Again, you need accurate and up-to-date financial information, reliable financial information for that. So, yeah, so that's in a quick under an hour, why your financial statements are important, what goes into financial statements, and really what I was looking to get out of today is how do you read financial statements? How do you go through those statements and gather the information that you need in order to make proper decisions for yourself or for your business? So that's all I had for today. Yeah, hopefully that information will help you out. And yeah, we'll jump into business valuation next week.
Thanks, Drew. I thought that was great. It was a great refresher for me. I like your kind of inside tips and tricks. My thing is to judge people by their grammar. I see you judge people by their financial statements. Not only the people running the business, but their accountants. So that's a hot tip. That was fantastic. I'm sure there's lots of that's going to develop a bunch of questions, generate a bunch of questions from people that watched. I will potentially ask you for that slide deck and make it available to people on our YouTube channel as an attachment. So the people who couldn't attend at lunch, kids are back to school today, so we're back to another round of, as you well know, of juggling our lives and getting back to yet another normal. So Wes Patterson says, great presentation, Drew. I agree. Thanks, Wes, for the kind words. So I'll get this video up as soon as I can. I'll attach that slide deck if that's available from Drew. And we will see you next week, the same time, same place in a week. And then we're going to have a 1 week break until June 15th. So thank you again, Drew, for doing this for us, for all of us. We know this is a slow burn. So those of you that watch this video, feel free to share it with friends. We really want to give people that 5-year lead to ruminate on this, go through these presentations, and make an appointment with Drew to talk about how to best position themselves. Another thing that came to me is, admittedly, I kind of do these with the mindset of we've got an existing business owner who doesn't really know how to transition out, but I thought today's presentation was really outstanding for the person who wants to buy the business. It didn't really occur to me until we started going into that and learning how to interpret those financial statements and look for red flags, or even just general practices.
So if you're an existing business owner and you're presenting your financial statements, you got to think about when you're selling, the reader of those financial statements is going to be looking at those things.
Right.
Yeah, it goes on both sides.
Yeah, and the reader of that financial statement is probably not going to be somebody as illiterate on financial statements as me. It's probably going to be somebody like you. Mm-hmm. So that's a great insight for people on both sides of the buy-sell equation. Yeah. On that note, it's 12:58. I'll let you wolf down your lunch and get back to your clients and your appointments. Thank you everyone for attending, and we will see you in a week.
Thanks, Mike. See you next week.
Cheers.